Next component is multiple candlestick lines. These are candlestick patterns that are made of more than one candlestick line. So we're going to separate them into bull double candlestick lines, and double candlestick lines, and so forth. So first we're going to look at the bull signals. The first of these is a bullish engulfing pattern. That's where we have a white candle wrapping around the black real body. The market has to be in a downtrend, and all that need happen is real body wrap around real body. The white real body does not have to wrap around the shadows. And I'm going to tell you why in a couple of minutes that becomes important. How that's going to give you a signal that those who use the bar chart don't get. Potential bottom reversal. And as with many of the candlestick signals, support or resistance, we use it as support. The lowest low of the two candlestick lines becomes our potential support area. Okay, and once again, if you have any questions on any of the candle patterns I'm talking about, just feel free to raise your hands. So here we have a classic bullish engulfing pattern, and the reason I call it a classic bullish engulfing pattern is because ideally we want to see the first real body, black real body, it could even be a doji, small. Why do we want to see the first candle small? What would a small real body tell us? Yeah, bearish momentum is slackening, exactly. And then the next candle, ideally, should be a vibrant, tall, white real body. The bulls are, you can see visually the bulls have taken over from the bears. It makes sense, right? Yeah. Graphically, and this is why you can scan through lots of markets and pick up these signals very quickly. If you're not using the scanning software, you might just be looking at markets on your own. So this is a classic bullish engulfing pattern, giving the bulls more confidence. The bears are shaking, I would say, shaking in the boots, right? All within a couple of candlestick lines. If you think about it, the candles give you potential reversal signals in 1, 2, or 3 sessions. Most of the bar chart strategies, oscillators, moving averages, you have to wait days and days and weeks to get those signals, right? With the candles, as shown in the slide early in the session, they use the individual candle lines, the short-term candle signals to gauge the psychology of the market. So here, we're getting a sense of the market psychology changing within a couple of sessions. And we talked about the shadows before. Series of lower shadows, lower closes here. But the lower shadows is mitigating some of the bearishness, and the final turnaround signal came with what? The white wrapping around the black. Remember, for the bullish engulfing pattern, all we have to have is the real body wrap around the real body. Okay, here we have a bullish engulfing pattern that wrapped around 1, 2, 3, 4 real bodies. Okay. Once again, this is a 1-minute chart. Now, just because it wraps around so many real bodies, does that mean the market's going to have a strong rally? No. It does increase the likelihood of it indeed rallying, or it should be a good support area. And this idea of the white candle wrapping around a series of black real bodies, or doji, this is a 1-minute chart, and I want to go from one extreme to the other. Okay, there's a 1-minute chart. This is a weekly chart of crude. Okay, so we're going from a 1-minute to a weekly, and this is going back to the late 90s. Back then, I was following a crude oil for one of our clients, and that's how I do the markets. Our clients, our institutional clients, will tell me which markets they want me to follow. And this was when crude was $11 a barrel. Speaking of remembering antennas, car antennas, right, and telephone booths, right, and typewriters and carbon paper, right? I remember when crude was $11 a barrel. Gas in New Jersey back then, I think, was 78 cents a gallon. But the reason this was so interesting, the reason I wanted to show you this is besides showing you the dynamics of using candles on a 1-minute and a weekly, is look at this bullish engulfing pattern. This white candle wrapped around 1, 2, 3 black real bodies. So that prior chart just reminded me of this one. And once again, it doesn't mean crude's going from 11 all up to infinity, but it does increase the likelihood of a reversal. Now, what's interesting about this also, this is a nice example, especially on the future side. It's very easy to short. So let's say you're short here. Would you be comfortable as the market's moving down with these long black real bodies? Yeah. Now, how about anything going on here if you were short? You'd be a little worried. Small real bodies. What's happening to the lows? Going from lower lows to what? Right. So, and then the final confirmation comes with a bullish engulfing pattern, right? Okay. So, small clues and a gradual change to a bullish engulfing pattern. It was actually, and this is a true story, I think this was a coincidence. I was at a card store, and there were a group of adjacent cards, and first one was Get Well. Obviously somebody was not feeling well. The next one was Hope You Get Over Your Serious Illness. The next one was Condolence. And I'm not making this up. The next one was a marriage card. Have a good marriage. And I'm thinking, I don't know which is worse. The Japanese have a great expression. Let me see. A perfect marriage, let me see if I remember it, is a blind wife and a deaf husband. I don't agree with that, but I think it's just interesting. Now here we have bullish engulfing pattern. There's nat gas. And the white candle wrapping around, again, a series of small real bodies. But even before that, we had these doji over here, showing the prior downtrend is running out of steam. Now, what I want to do, and I mentioned this, anything hinting the bear's losing force, obviously. What I want to do now is, and again, as I had mentioned at the beginning, this is really not a Forex seminar, but we are looking at Forex markets, so I just want to discuss some of the nuances. With the 24-hour market, the single candlestick lines are going to be the same, whether it's Forex or non-Forex. But when you start getting to the multiple candlestick lines, there are some nuances in the Forex. Let me explain exactly why. The traditional bullish engulfing pattern looks like this. Traditional means equities, futures, interest rates. The market gaps down on the opening compared to the prior close. Okay, so this is the opening. This is the opening over here. This is the prior close. This is the opening, and that's the close. Because the Forex market is a 24-hour market, the opening and closing are just about the same, or within a pip or two. Forex are really, really popular. When I was doing my research into the candles in the 80s, the most savvy technical traders were futures, because this is in the 80s when you did a stock, you bought and hold. This is pre-internet. So the candles were really popular on the future side because they wanted those short-term turning signals. The 90s, equities, candles really took off because of not only day trading, but internet access and retail traders. Over the last few years, it's Forex. Probably the most important technical market where the technicals are most important is definitely Forex. Okay, the highest percentage of traders. Because how do you gauge all the news? Political relationships, interest rate relationships. Look at the chart. One of the great advantages is there's a limited number of markets. You don't have to worry about it. You can just focus on particular markets, great leverage. But anyway, so in the Forex, here we can have the opening and closing the same, or a couple of pips within one another. Okay, so that is perfectly acceptable in the Forex market. So here in the dollar Canadian, US Canadian, and once again the strategies are the same whether it's Forex or not, but I just wanted to show you the nuance. This is a bullish engulfing pattern. On the blue arrow on your left is the close, and on the red arrow on the right, the opening and closing are the same, and that's perfectly fine for Forex. And by the way, the law of the bullish engulfing pattern becomes a support area. Okay, so here we have a series of bullish engulfing patterns. And we're going to look at this slide in more detail in a couple of seconds. Okay, so we have a white wrapping around the black, a white wrapping around the doji, another white wrapping around the black. Now, even before that shooting star, and actually I would view this as a shooting star also. Oh, a series of shooting stars, this one and this one. So here we have these shooting stars. Now, it's interesting because these candle lines are making higher highs, right? Is the market able to hold the highs into the close? No. And not only that, but it's pulled back a lot. Now, another shooting star over there. Didn't work. Obviously, not every candlestick signal is going to work. That's what stops are all about. Here we have a bullish engulfing pattern, and the low of the bullish engulfing pattern should be a support area. Now, what you're going to find is that, although we're going to get a little ahead of ourselves, when we talk about trade management, we'll look at risk reward tomorrow. Where would you think it's more likely reversal? If you had a really tall white real body or a relatively small white real body wrapped around the black tall white real body. But think about, again, that key concept of risk reward, right? If you have a really tall white real body by the time you get the signal, but the reason I want to mention that now, if you have a really tall white real body and at the time it's created, it's a bad risk reward, then we use the concept, and we can do the same thing with the hammer or the shooting star. We could use the concept of using the candle lines as potential support or resistance and see how the market acts at that potential support or resistance. So let's imagine this was an unusually tall white real body. This risk reward looked fine. I would have had a target up here. But let's say it was a really tall white real body over here. You say, okay, I can't do the trade. It's a really bad risk reward. You could set your whatever software you're using or mentally remember it or print out a chart. Draw a trend line, and if the market gets near the support area, what have you done? If you're buying it down here, what have you done to your risk? You've lowered your risk. Exactly. So many of the candlestick signals, yes, it's better if you have a really long upper shadow with the shooting star, but it may be a bad risk reward. Wait till the market gets close to that resistance. If it does, it may not, but wait till the market gets to that resistance area and then think about pulling the trigger. And that's why I added how to use them as support or resistance, not only as far as stop-out levels, but thinking, at the time the candle signal was formed, it may be a bad risk reward. Then you bring into the idea, the aspect of the support or resistance of that candlestick line. Okay, here we had a series of bullish engulfing patterns. This was in the Dow, and on the left side, not only was it a bullish engulfing pattern, what about those shadows on the left? Wow, yeah. Huge, long, lower shadows, exactly. So right around that level, another bullish engulfing pattern over here. And no real reversal signals here, okay, but the point is that the market held the support area. So this was really nice because not only did we have the bullish engulfing pattern, but you could see the vibrancy, the extent, the rapidity with which the market rejected those lower levels. What we're going to do now is we're going to continue with our dual candlestick signals. And we looked at the bullish engulfing pattern. Now we're going to be looking at the piercing pattern. And the piercing pattern, potential bottom reversal made of two candlestick lines. Market is in a downtrend. Basic criteria. It opens below the prior low or the prior close. I like it better when it opens below the prior low. And I'll explain why in a minute. And then the white candle closes more than halfway into the black real body. We want to see the bulls intruding deeply into the bear's territory. The Japanese have saying, thieves in the dark hate the moonlight. Okay? Thieves in the dark hate the moonlight. And here we have, some thieves, and here's the darkness, and here's the moonlight intruding onto the darkness. So the white candle has to get deeply into the black real body. It's a potential bottom reversal signal, and we use the lowest low of the two candlestick lines as a support area, just like we would with the bullish engulfing pattern. And here, okay, we have a piercing pattern. Gets more than halfway into the black real body. And a lot of these patterns tomorrow, if not all of them, we're going to be looking at ways of combining volume with candle signals. So for example, just to get a little ahead of us, what we had planned on talking about today, but we're going to focus on tomorrow, is when we like it better if on the long black real body it's lighter volume, and on the white body, whether it's a piercing pattern or bullish engulfing pattern, we have heavy volume. Yeah. Right. So this is just a very easy way, one of the many ways we'll be looking at combining candles with Western technicals. So here we have a not piercing patterns. Why are they not piercing patterns?
The bodies.
Right, the bodies didn't get more than halfway into the black real body. It doesn't mean just because it does, the market's going to rally, but the definition of a piercing pattern really has to be above the middle of the black real body. Interestingly, we're going to be looking at another pattern a little bit later, the dark cloud cover, when we look at the bearish signals, where it does all the definitions with the piercing pattern is it has to get above the middle of the black real body. But when we look at the dark cloud cover, some of the definitions I had in my candlestick literature, the dark cloud cover is a potential top reversal. It didn't have to get below the middle of the white candle. But we'll get to that in a couple of minutes when we talk about the bearish reversal signals. So here we have early clues of shifting supply and demand. So the bears are in charge. Bulls intrude a little into the bears' territory, a little bit here. Here's where it gets more than halfway into the black real body. Okay, so this is the third green candle is the piercing pattern. Now, I chose this slide to bring out something interesting. One of the things I've done in my most recent resources education, I mentioned, the books are great. They're a good basic. I don't want to say basic. They're good foundation. But all the newest stuff, all the newest material, as I mentioned in the introduction, is based on my more recent material. And one of the things I've done is there are so many candlestick signals, it can be overwhelming. So I just really focus now on the most important and the simplest and the most accurate candle signals. And the challenge is there's so many candlestick signals, it can be a little overwhelming. So I really focused on, maybe 13, 14, 15 candlestick signals out of maybe 30 or 40. And let me show you a way we've done this. These are actually all candlestick signals. This is a candlestick signal here. This is a candlestick signal here. We know about the piercing pattern. But I don't even look at those candlestick signals. Let me show you. For those who have my books, my first book, I discuss these patterns, the on-neck, the in-neck, the thrusting, and then the piercing pattern. And essentially, the on-neck is when the close is below the prior low. It's a white candle that pushes up, and the close is below the prior low. An in-neck, the close is the same as the prior close. And then the thrusting, the close is above the white candle. The close of the white candle is above the close of the white candle is above the close of the black candle, but it's not more than halfway. But essentially, I don't talk about those anymore because these are not bullish reversal signals. Okay, these are actually, the trend is still essentially down. The market is not intruding deeply into the black candles. The Japanese would say there's not enough power to show that the market's going to continue to rally. So here we have a piercing pattern where the white candle is more than halfway into the black real body. So the only one I really focus is on the piercing pattern. You don't have to remember the other three. It's just the piercing pattern we're concerned at. So as explained here, patterns 1, 2, and 3 are viewed as small reactionary rallies, okay, where the bull's counter drive is weak. Okay, so the piercing pattern has to be above the middle of the black real body. Don't worry about the other ones. Now, another potential bottom reversal signal is a bull Harami. The market is in a downtrend. The first candle is an unusually long black real body. The second candle could be black or white. It has to be a very small real body, or a doji, that's within the prior real body. The Japanese would say the market is losing its breath. The prior trend is losing its breath. And we don't use this as support or resistance. Okay, and Japanese would also say the upward power of the market has dissipated. Okay, so here, and this is a nice example of showing the separation of the market separating from its trend. Black real body. Black real body. I don't know if this was quite a hammer. Okay, it might be twice the height of the real body. But nonetheless, nice long lower shadow. The market's holding support here on this black real body, but no signs that the bulls are losing their power, their drive. And this Harumi here, this black, the Japanese call this a black-white Harumi, is showing us the market is separating from its trend. So it's a small real body and a big real body. If you want a definition, a comparison, the second real body should be 25% or less of the prior candle.
The real body.
The real bodies. Because we're comparing an unusually long real body and then an unusually small real body. Now, I should point out that a lot of these things, like the bull Harumi, the Japanese would say, as I had mentioned, the upward power of the downward power of the market, the energy of the market has dissipated, or the downward power of the market has dissipated. Whereas something like a bullish engulfing pattern, where the bulls had taken control of the market from the bears. So something like a bullish engulfing pattern, where a white candle wraps around a black real body, is a more significant potential bottom reversal signal than a Harumi. Okay? So here, and I think we can understand the difference between the two. With the bullish, and I think bullish might be too strong a word, but that's what the Japanese call the bullish Harumi, is the trend has turned from down to neutral, kind of like a doji idea. But what about the bullish engulfing pattern, where the white candle wraps around the black? The trend has turned positive. So there are certain nuances with candlestick signals. For example, the doji, the trend is neutral. The Harumi will be looking at the bull and also the bear. The trend is more neutral, but more of them are significant reversal signals, where the bulls are taking over from the bears. Here, the market is turning from down to neutral. Everybody see the difference? It's a subtle difference. Okay, why is that not a Harumi? The one that just emerged up there? Right, it's not within their real body, exactly. Okay, so here we have another bull Harumi, and interestingly, the market is moving up, but what gets us nervous about the rally? What about those real bodies? Small real bodies. So although the market's ascending, it's not doing, with vibrancy. And also, what about the shadows? Interestingly, this is eBay. And sometimes you get something like this on short-term intraday charts that don't have really good candlestick signals, but eBay, this is a daily chart, and so this is interesting. But what about the shadows also? What is that showing us? Long upper and lower shadows? Do you think there's any conviction either way? No, exactly, right. Long upper and lower shadows showing us this is a confused market. So not surprisingly that the market pulled back from here. Okay, here we have another bullish Harumi. And again, kind of beyond the scope of the session here, because I have a specialized resource on Forex. But all the Harumis you're going to get in Forex are going to look like this. There's no way around it. Okay, you're not going to get a Harumi in the Forex where the market gap's high, where you have a real body up here. Okay, because the Forex is a 24-hour market, the opening is always going to be the same as the prior close. And it's always going to be a white real body, because if this was a black small real body over there, would that still be a bullish Harumi? No, it would be under the other candle. So just FYI, all the bullish Harumi in Forex are going to look like that. Any questions about the bullish engulfing pattern, the piercing pattern, the bullish Harumi? And remember, the bullish engulfing pattern is a white candle wrapping around the black real body The bears are dominating over the bulls. Ideally, the bullish engulfing pattern, the first candle line should be small, and then the second one should be long. A piercing pattern kind of related to the bullish engulfing pattern, except the white candle doesn't wrap around the black real body. It gets more than halfway into the black real body. And then the bullish Hadarami, small real body, it could be black or white. The second real body could be black or white. In the Forex, it's always going to be white with the bullish Hadarami, but non-Forex futures and so forth, the color of the real body doesn't matter. The second one could be a black real body as long as it's 25% or less of the first candle. Now, let's think about this. The Hadarami, the bullish Hadarami, is, and that's a tough word to say because my translator told me it's a cross between an R and an L. So Hadarami, it's very hard. You have to do an R sound and an L sound. And I don't speak Japanese. I spend so much money on translation. I asked my translator, could I teach myself Japanese? He said it's easier teaching yourself surgery. It's because they have three languages, they have three alphabets. It's just amazing. But so with the bullish Hadarami, we have the second candle is a long black real body. The first candle is a small real body. Okay, what is that the opposite of? One of the dual candlestick signals we saw, where the first one is small and the second one is big. The engulfing pattern, right? This is the flip side of the engulfing pattern. In the engulfing pattern, the first candle should be small, ideally, and the second candle should be large. Here, the first one should be small, and the second one should be large. Another difference is the engulfing patterns really have to be the opposite colors. Okay, a bullish engulfing pattern, the first candle should be black, or a doji, and the second candle could be white. The Hadarami, the ones I've showed you had opposite colors, but they could even be the same color. Okay, that is not a bull Hadarami because it's not within the real body. Now we're going to be looking at the double candlestick lines from the bearish perspective. Just as we saw the bullish engulfing pattern before, we're going to look now at the bearish engulfing pattern. Okay, the market's in an uptrend. Black real body wraps around a small white real body. Potential top reversal. And a resistance area, the highest highs of the two candlestick lines. So if we had a long upper shadow here, the top of the upper shadow would be the resistance area. And here we could see, obviously, that the bears are overwhelming the bulls. Right? So here, the FTSE, once again, this is good in all markets, European markets, American markets, doesn't matter on the FTSE. Bearish engulfing pattern, a little clue even before the bearish engulfing pattern with the doji. Okay, what signaled at least a temporary bottom? I don't know what happened after this, but okay, what do we have at the bottom? A hammer, right? Right. And here we have a bearish engulfing pattern we're using as a resistance level. And this brings to mind something I'd mentioned before with the engulfing pattern. Remember I said if we had a really, I don't want to say more bullish because that gives you the implication the market's going to rally stronger, but a more likelihood of a reversal. A really tall white real body and a small white real body is compared to a small white real body for the bullish engulfing pattern. And if you have a really big white real body, you could maybe use that as a support area because if you have a bad risk-reward at the time of the bullish engulfing pattern, you could wait for a pullback. If the market pulls back to the support area of the bullish engulfing pattern, to think about buying it. The same thing with the bearish engulfing pattern. This would not be a bad trade because it's a bearish engulfing pattern and you're not near a support area. However, if this was a very long black real body, I mean, I'm just going to make a crazy amount of black real body. Let's say the black real body was all the way down here. Okay, you would say, okay, this is a bad trade because our risk would be up to here, and maybe our target would be here. So let's imagine the black real body closed here. Let's imagine this was it. Okay, instead of that one, this one. So what you could do is wait for market to rally to the resistance area of the bearish engulfing pattern. So here we have a shooting star or variation, but either way it becomes resistance, the bearish engulfing pattern. Now, the green semicircle is a bullish engulfing pattern. And the low of the bullish engulfing pattern becomes potential support. Now, this gets back to a question asked before. We have a bullish engulfing pattern. So if we happen to sell or do a bearish option trade at the bearish engulfing pattern, first of all, a couple of things, and I'll talk about stops on this. Do we have a stop above this bearish engulfing pattern if we're short here? Or do we do it here? I would give it a little leeway. See that? It's so close, and I'll read the numbers here because it may be a little hard to read on the screen. The high of the bearish engulfing pattern is $30.80, and this is $31.10. So 30 cents different, in a $30 stock. So you would probably give, or I would certainly make it a zone of resistance. R1 would be between 30.80 and 31.10. Same situation. If you're thinking about buying on this bullish engulfing pattern, which I would not be doing, although it's at support, why would I not be buying on that bullish engulfing pattern? Are there any signs the bears are losing steam? No. And we're going to look at this in detail tomorrow when we talk about support and resistance. The market's at support, but there's really no candle reversal signals. Okay? But let's say, for whatever reason, you're bullish on this correction here, on these black real bodies, and you're going to buy in the bullish engulfing pattern. Now, the reason I highlighted the bullish engulfing pattern here is the bearish engulfing pattern. We'd have this as a potential target. Okay, we may have first support over here, next support down here, but we're at the bullish engulfing pattern. But if you bought on this bullish engulfing pattern, would your stop be under the low of the bullish engulfing pattern, or would it be somewhere else?
Long, dark candle.
Yeah, the low's here. For the same reason. Everybody see that? Just as because this resistance area is only a few cents away from this engulfing pattern's resistance, the same thing here. Although we have a bullish engulfing pattern support at $26, the lows here were $25.70, 30 cents difference. So when do you hate to get stopped out if the market gets to $25.90? Yes, it did get under the bullish engulfing pattern, but did it still hold that close? Hold that support? Yeah. So I'd make us a zone over there. So this is actually what we did. Okay, and the market had rallied from there. But this is a good example to show you how if you have a support or resistance area close to a candle support or resistance area, I would nudge it a little bit. Now in the West, there's something called an outside or key reversal. And what this is, it's a Western signal. A bottom outside reversal is when the market moves down, it makes a lower low, and then closes above the prior session's close. Okay. So it's a bottom outside reversal and a top outside reversal. And there's an example here. The market makes a higher high and then closes under the prior close. Some technical analysts wanted to close under the prior low as well, just as they wanted to close above the prior high here. But nonetheless, a top outside reversal, market's moving up, we have a higher high, and then the market closes under the prior session's close. And let me show you how the candles will give you a jump on competition. Okay, so I just put the top outside reversal pattern on a bar chart. My hands shake when I try to draw a bar chart. My body doesn't want to do it, I have to go like this. And it's interesting because when I was doing my research on the candles, remember there were no candlestick charting packages. I had to draw all my candles by hand, every market. So right now it's great. We just press a button, have a candle chart. So here we have the top outside reversal. Now we have a couple of bearish engulfing patterns. This happens to be on the Dow. Now look at the first, actually look at both of them, those black real bodies. Did those black real bodies make new highs for the move?
No.
No. Right? So remember, one of the criterion for an outside reversal is that it has to make a new high for the move. So if you were not using candlestick charts, if you were just using bar charts, you would not have gotten a reversal on this. Everybody, do you want me to go through that again? Or you see that? Okay. Because neither of these black candles made a higher high, but because the definition of a bearish engulfing pattern is black real body wrapping around a white real body, we got turning signals. which those who were only using bar charts, like an outside reversal, would not have seen. And this was interesting because we take the high of this bearish engulfing pattern, what becomes resistance? The high of the two candle lines that make the bearish engulfing pattern. And what confirmed the resistance? Another bearish engulfing pattern, probably a shooting star. So in both instances, in both these bearish engulfing patterns, we got reversals you would not have gotten on Western charts. Okay, here, the bearish engulfing pattern, the black real body wrapping around the white candle. Now, here we have a bullish engulfing pattern, and it didn't work. As soon as the market closed under it, we know it's wrong. Now, the bearish engulfing pattern shown by the red arrow is one I would think about initiating a trade. We'd have to see, once again, for those familiar with gaps, we'll talk about that later, if this black real body closed under that gap. Assuming it did, with this bearish engulfing pattern, we could think about selling it. But based on what I have here on this slide here, on this bullish engulfing pattern, why would I use that? And once again, don't worry if you don't know the answer, because I just touched on it. We're going to go a lot more detail tomorrow. Why in that bullish engulfing pattern would I think about maybe not? I would use that to cover shorts. And remember, I said there's a time to initiate a new trade with a candle signal, and there are times to think about just using that candle signal to offset a trade. Remember what I said about when we should initiate a new trade with a candle signal? Confirmation. Yeah. And once again, don't worry if you don't remember it, because I said don't worry about taking notes. We're going to look at it tomorrow. But this is a nice case of that. So here we have a bearish engulfing pattern, assuming it closed, because the gap here is a potential support area. But as soon as it closed under this gap here, either here or here, we would use this to think about initiating a new trade. Why? Confirming resistance. Whereas this bullish engulfing pattern, okay, assuming it's not confirming support, we would use this not to initiate a new trade, but to offset a current trade. But let's say, once again, you may have a Western signal that to you gives confirmation of that bullish engulfing pattern. If you went long on that bullish engulfing pattern, as soon as it closed under it, you should be out of long positions. In the translations I had done, actually in one of the faxes, one of the head traders, and I forgot what shop, may have been Fidelity, Magellan in Japan, I forgot where it was, but he says he looks at Western technicals and adds candles, but the final trigger is candles. Okay. So you may have a group of signals, Western signals here, and then you're getting confirmation. The final trigger is the bullish engulfing pattern, but there's always a price that says you're wrong. Dark cloud cover. Just as a piercing pattern is related to a bullish engulfing pattern, where the white candle wraps around the black the white candle wraps around the black, with the piercing pattern, the white candle gets partially into the black. Here we have the dark cloud cover is related to the bearish engulfing pattern. The bearish engulfing pattern, a black real body that wraps around a white real body. The dark cloud cover, the market's in an uptrend. Then we have a black candle that should get more than halfway. Oh, well, let me backstep here. The basic criteria. Opens above the prior high or close. In this case, we have it with the close. And the black candle closes deeply into the long white candle. Potential top reversal. Resistance should be the highest high of those two candlestick lines. So the high of those two patterns of these two candle lines, this one over here, is our resistance area. The piercing pattern, all the definitions was it has to be more than halfway. Interestingly, that was not the case with the dark cloud cover. The dark cloud cover, some analysts, some of the literature I had translated, some of the Japanese traders I've spoken to or emailed or faxed, would say that it's a dark cloud cover either if the close here was below the close of the white candle. Some of the literature said that it's only a dark cloud cover, kind of the flip side of the piercing pattern, Only a dark cloud cover if the close got more than halfway into the white candle. One of the early challenges I had when I was working with the translations is, what do I pick? Which way do I go? And I went with the idea that dark cloud cover has to close more than the middle of the white real body. Because doesn't it make more sense? The more the bears are intruding into the bull's territory, the more likely reversal. So I went with the more aggressive definition of the various definitions I had with the dark cloud cover. So it has to close more than halfway into the black real body. Such as this. And this is such a great example of how in a couple of sessions, by visualizing what's going on with the candles, we know what's happening between the bulls and the bears. Look at the shift from one session to the other. Look at the psychology changed. Bulls are in charge. The market gaps higher in the opening. Bulls are happy. Anything different by the end of the session? Yeah. Oh, yeah. All within a couple of candlestick lines, once you know how to read them. A shift in psychology. Okay, that is not a dark cloud cover because the black candle didn't get more than halfway into the white real body. Okay, Forex. Once again, the universality of candlesticks. The dark cloud cover becomes a resistance level. Market gets there. On this white candle, no real signs. The bull's losing momentum. This is the first sign, the doji. And see how this doji, we would act completely differently on the doji. You could have an exact same candlestick signal. And this is something most traders don't realize, even those who think they know candles. You could have the exact same candlestick signal, but you trade completely differently on that candlestick signal depending on the candles in context. Here we have a doji. Why would we think about selling short on that doji? It's confirmed resistance. If we had a doji not confirming resistance, we don't sell short. We use that to lighten up on longs. We protect our profits. Same signal. It all depends on where it appears within the market. And the next session, as though we needed confirmation, actually was a bearish engulfing pattern. And remember the flexibility, especially in Forex. The opening and closing could be the same. So here in this dark cloud, the opening and closing are the same. The opening here is the same as the prior close. And same thing here, the doji and the opening over here. So bearish engulfing pattern.
So the confirmation was the resistance?
The confirmation but with the doji and the bearish engulfing pattern was confirming a resistance level. Okay, the question is, would you enter on the bearish engulfing pattern from the short side? I would probably enter from the doji. And there's nothing saying you initiate a short or some option strategy over here lightly, and then this is your confirmation, and then you become fully involved in the trade. Here we have a bearish engulfing pattern. A dark cloud cover, almost a bearish engulfing pattern. And the reason I wanted to show this is because it's in the futures market. The first one we saw was in the one before this was Forex. This is futures. This happens to be gold. Okay, equities. Again, just the universality of candles. Dark cloud cover becoming a resistance area. Same thing here. Dark cloud cover. So again, the dark cloud cover related to the bearish engulfing pattern, but the bearish engulfing pattern is the black candle wrapping around the white candle. And it's been years since I looked at my book, but I think in my book, because if you ever write a book, you never pick it up again. I have not, because you proof it and you proof it and you proof it, and you get so tired of proofing it. That's it. It's history. So, but I think one of the things in the book I mentioned, I made a comparison between the dark cloud cover and the bearish engulfing pattern, And the bearish engulfing pattern is like a total solar eclipse that blocks out the whole sun, whereas a dark cloud cover is like a partial solar eclipse that blocks out part of the sun. So the dark cloud cover gets more than halfway into the white real body but doesn't wrap around it. Now we're going to be looking at a bearish hydrotomy. Once again, the bearish engulfing pattern, the dark cloud cover bearish engulfing pattern are more aggressive or more likely reversal signals because we can see one side, i.e. the bears, are taking over from the bulls. Here, we could see the bulls, the bearish hydrotomy is showing us that the bulls are losing control. Doesn't mean the bears have gained control. So we have a long white real body, the bulls are in control, then a small black or white real body, 25% or smaller than the white real body. Market's in an uptrend. So we don't use this as support or resistance. We have a bearish hydrotomy. Same thing here, but we wouldn't be selling on this one. We would be using it to lighten up on longs, not only because it's not confirmed resistance area, but this is actually, and this is one of the techniques we'll be looking at later, rising windows. Some of you may be familiar with it. We'll talk about rising windows and falling windows when we talk about continuation candles in a little bit. But this is a potential support area. And in fact, you could see how it held its support over here. But this is a market, once again, it's a great way of seeing a market separating from its trend. The bulls are losing their breath on that bearish hydrotomy. Now think about this. The market closes here on this tall white candle. What happens the next session? Gaps down. And are the bulls able to make much progress from the opening? No. Okay, so here the market, the bulls are losing their force. But we're going to use this to lighten up on longs because we're near a support area again. For those not familiar with windows, we're going to talk about that in a little bit. But look at, it's interesting how as good as things looked up here initially on this tall white candle, then we got an indication that the market's losing momentum here. Notice what happened again near those highs. Long upper shadow, I would call it, this is definitely a shooting star. I don't know if this is quite a shooting star. The upper shadow might be too long, but nonetheless, look at those upper shadows over there, just showing us time and time again at that resistance up at near 86 that the market was stalling.